Welcome to Talk Tickers. Today we're diving into a really interesting one. Leidos, ticker LDOS. Their latest earnings report sparked a huge disconnect between what the company was saying and how the market reacted. And, well, that's the paradox we're going to unpack today.
So here's how we're going to break it down. We'll start with that big contradiction in the headlines, then we'll really dig into the numbers. After that, we'll look at management's big bet for the future, and finally we'll wrap it all up with our own thesis on what to do next.
All right, first up, the headline paradox. This is all about how a mixed earnings report led to a really sharp and, frankly, pretty brutal reaction from investors.
And here's the conflict in a nutshell. On the one hand, Leidos absolutely delivered on profit. Their earnings per share came in at $2.76, which was a nice beat over the $2.61 analysts were looking for. But, and it's a big but, they missed on revenue, bringing in just over $4.2 billion when the street expected over $4.3 billion. It's that classic beat and miss story.
And the market? It did not like that. The reaction was swift and decisive. The stock got hammered, dropping a whopping 8.4% in a single day. You know, this is the real mystery we have to solve. Why such a harsh punishment for a revenue miss when the profits looked so good?
So, let's start digging. We've got to get to the bottom of this disconnect between the story management was telling and what the market actually heard.
And this table just lays it all out perfectly. I mean, look at the bottom half. EPS growth is fantastic, up 19% and 16% year over year. That's solid execution. But the market just blew right past that and locked onto that top line. A 4% decline in revenue year over year, that's the number that sent a chill down investors' spines.
And yet, what did we hear on the earnings call? CEO Tom Bell called it an outstanding 2025. That right there is the gap we're talking about, the huge difference between how the company sees itself and how Wall Street sees it.
Management really wanted everyone to focus on these points. They were talking about incredible cash flow, $452 million in just the fourth quarter, a record for the full year. They were highlighting expanding profit margins. Their whole argument was, hey, look, the business is fundamentally healthy. It's a cash-generating machine.
So you have to ask, right? If the company is basically printing cash, why didn't investors care? What was the bigger, more pressing concern that overshadowed all of that good news?
And the answer really is it all came down to a crisis of confidence about the future. For a company like Leidos, revenue growth is everything. It's the ultimate sign that you're winning the big, long-term contracts that fuel the business. So when that number actually goes backward, the market gets scared that today's profits are just masking a weak growth engine for tomorrow.
Okay, so let's look at their plan to fix this. How does Leidos plan to get that top-line growth fired up again? It all comes down to their new guidance and one massive strategic bet.
First, the guidance for next year, well, it was kind of just okay. The midpoint of their earnings forecast landed almost exactly where analysts already were. It was perfectly in line, and in this environment, in line just wasn't enough to get anyone excited or change the narrative.
So if the guidance isn't the growth story, what is? This is their big answer. A massive $2.4 billion all-cash deal to buy ENTRUST Solutions Group, which is a big name in energy infrastructure.
This deal is their big swing for the fences. They're taking on debt to pivot into these high-growth areas, like modernizing the electric grid. But, and here's the catch, the deal isn't expected to actually help earnings until 2027. So that makes this entire next year a show-me story. They're essentially asking Wall Street to be patient and trust them while they get this thing integrated.
All right, let's put all these pieces together. With all this context, we can finally build a real, actionable thesis for Leidos and figure out what we should be watching.
And that's the multi-billion-dollar question, isn't it? Was that huge 8.4% drop a total overreaction, making this a screaming buy? Or did the market get it right and there's just too much risk here?
To figure that out, here's what you need to keep your eyes on. First, revenue. Can they even hit their own targets? Second, that big ENTRUST deal. Does it close on time? Do we hear good news about integration? Third, can this new energy business actually deliver the growth they promised? And finally, that book-to-bill ratio, are they still winning more new business than they're burning through?
So after weighing everything, our thesis lands on a rating of market perform. And here's why. You've got this awesome cash flow that creates a really solid floor under the stock. But at the same time, all this uncertainty about future growth is going to act like a ceiling, probably capping the upside for a while.
Now, a trade that really reflects this view is something called a bull-put spread. Just think of it like this. You're betting that the stock probably isn't going to fall much further. You get paid a premium to make that bet, and as long as the stock stays above a certain level, you get to keep it. It's a trade designed to make money if the stock just chops around or drifts slightly higher, which fits our floor but no major rally thesis perfectly.
And as always, please remember, this is not financial advice. You should always make any investment decisions with the help of a qualified professional.